Hey, welcome everybody. Let's talk real estate. Your weekly BS with Barry Saywitz about the current commercial real estate market here in Southern California. As we take a no BS look at both sides of the issues driving this market today to find the best solutions going forward. With our man right in the middle, Barry Saywitz. Hey, Barry.
Hey, good morning, Paul, and good morning to all of our viewers and our listeners out there. Welcome back. It's another Tuesday, and I hope the sun's going to be out here in Southern California. I expect it to be. I am Barry Saywitz, president of the Saywitz Company and managing partner of Saywitz Properties, and we're back here again talking some more real estate. We've got a wild, wacky week again in the stock market, again with tariffs, again with the economy, but with all of that going on, we're going to talk some real estate, and I'm excited about today's show. I want to welcome our guest, Rawson, who is co-founder and principal of WATERFORD Property Company here in Orange County. Sean, welcome to the show.
Well, thank you, Barry, and it's a pleasure to be here. It's always fun to talk real estate, so I'm excited to be here.
Yeah, and whatever we don't know, I told Paul earlier, we just make it up as we go. So that's kind of the plan and the lay of the land for today. But but what I thought we'd do is I want to go back to somewhat of the beginning and then talk about, number one, how you got into real estate, and then we can work our way forward to where we are today, and then we'll try and do some prognostication for what's going to happen in the future. But you got your start. If we rewind, you played basketball. In college, and at some point it was either Lakers or real estate, and then I guess talk about how you made that decision to go with the real estate was a safer move.
Yeah, no, it was a tough choice. I thought I was going to be the next LeBron James, but then as I got deeper into my college career and I was getting more splinters at the end of the bench, being a backup point guard at Claremont McKenna College, I figured that I should start planning for the future. And I actually thought I was going to end up going to law school. And my senior year, took the LSAT and applied to law schools, was fully prepared to go to law school. And then for fun, a good friend of mine at Claremont McKenna had told me he was interviewing for some investment banking jobs. And then specifically, there was a firm that caught my attention, the Concord Group, which is a real estate economics advisory firm based in Newport Beach. And for fun, I decided to interview, and going through that process, it really intrigued me in terms of the type of work that they were doing, which was third-party market studies and advisory work on behalf of private equity investors and developers. And I really was intrigued by that and decided once they offered me a position that I would give it a try, and if I didn't like it, I could always go back to law school. And so I moved to Newport Beach, and as I told you, it was a tentative yours, and lived in one of your properties while I worked at the Concord Group for 3 years. So it was a good introductory into real estate for me.
Yeah, and it's a small world, and I'm familiar with the Concord Group, and a good company and real good experience in terms of getting your hands wet. As far as looking at a variety of different deals that are out in the marketplace and trying to understand how to make sense of them. And so as time went on, you ultimately moved out of our place at the beach and moved upward and onward, and then continued on with real estate path. Never went back to law school, right?
I didn't. No, I went back and got my MBA from Mirage at UC Irvine in 2008 and finished that program in 2010. But no, I began my real estate career in actually September of '01. My first day on the job was the week of 9/11. So that was a very interesting time to start working, and then stayed with the Concord Group till 2004.
And that was an interesting time, not only with 9/11, but also, if I remember correctly, the real estate markets all sort of tanked at that point as well. Was one of those cycles. And then at some point, if we fast forward down the road, I mean, you've got the market runs back up from, call it 2004 to 2007, pretty good. And then you have the recession. But then at some point post-recession, you decide to go out on your own and form what is today WATERFORD Property Company. What was the epiphany in terms
Yeah.
of trying to go out and do it on your own?
Yeah, no, great question, Barry. And every entrepreneur has a little bit different story. Um, what I would tell you is, so just real quick background between the Concord Group and going back to business school. Um, I got into brokerage for 4 years because I realized I didn't have any transaction experience, and was working for a large land brokerage firm with Donald Atkins. So worked for Craig Atkins, who's now the co-founder or founder of City Ventures, and got really knowledgeable on land entitlement and development. And then in the spring of '08, decided that it was time to go back and get my MBA. So I started UC Irvine in the fall of '08, which was another really interesting time in the markets. My first semester at UCI, the Lehman Brothers collapse happened, and then what we now call the GFC. So I would like to say I was in business school for two of the most fascinating years of real estate, 2008 to 2010.
Yeah, and they can't teach you that. And the good news is you were to some degree on the sideline, fortunately, while everybody else was living the horrible nightmare.
Yeah, but at that point, I had, I think I was 30. I really wanted to be an entrepreneur, wanted to have my own company. Didn't really have a track record, so to speak, and didn't quite know how to get there. But during that period, and from 2008 to 2010, spent a ton of time. And as you remember, Barry, everyone was trying to figure out kind of what was happening in the world. And what was fascinating is that everyone had time. I remember calling up, what I would call very, very prominent figures in our industry, said, can I take you to lunch? And there was a lot of people that were generous with their time. And so I built a lot of relationships. One of the things, though, that I also did was spend a lot of time understanding how receivership works, and banks were taking back a lot of real estate and distressed, and I was able to get a couple consulting gigs for banks while I was in business school, helping them do workouts, which was fascinating. And really what I learned from it is that to be entrepreneurial in real estate, you really have to have a specific focus in a niche, and for lack of a better word, a competitive advantage. And it was really at that time that I turned my focus to affordable housing and said, this is an interesting way to finance acquisitions and development. And I always had a desire to be in multifamily housing. And so started researching affordable developers, and ultimately went to work for a large affordable housing developer out of UCI, with the intent of learning as much as I could, and then hopefully starting my own company someday.
And for those people out there that don't know, affordable housing is really twofold, in my opinion. One is it's government subsidized to the tune of where there's subsidies and tax credits for the developer or the owner or the builder. And then there's also government subsidies for the tenants that are coming in that are paying the rent. And then you also have what's called Section 8, which is I'll call it a spinoff of basically the affordable housing, right? And so as the builder, as the investor, you're really looking to government subsidies to be able to facilitate making a project work, and they want to be able to provide affordable housing to folks that are out there in any community, and they need developers and builders out there to be able to do that for them.
Yeah, no, that's very well put. So, and just for those listeners that aren't familiar with it, specifically the low-income housing tax credit. So the acronym is LIHTC, and it's a product of the 1986 Tax Reform Act. The time President Reagan created the tax credit as really an incentive to try and get private capital to blend with, to your point, government subsidies to help in the creation of affordable housing. For anyone that wants to get super nuanced on it, it's Section 42 of the IRS tax code. But it's very prescriptive and very nuanced from a legal perspective.
And very paper intensive for the people that are doing it, right? I mean, it is not for the faint of heart.
Correct.
And you really, that is a niche. And if you can be successful in it, the companies that are in it that are successful do very well. It's just not something you can decide, hey, on a Friday, I'm gonna go into affordable housing and then I can figure it out by Monday. It doesn't work that way.
Yep. But you know what intrigued me, in addition to the policy attributes, the mission, what really intrigued me about it, Barry, and you can, I think, appreciate being an entrepreneur yourself, is the creativity that you can use to finance projects where you're able, depending on the way you structure the capital stack, as an upstart developer, early on, you can get very creative and get additional leverage in the way that you structure deals. But in addition to that, unlike merchant builders or for like institutional multifamily developers where you have an LP, an institutional capital partner, that'll put in oftentimes, 80 to 90% of the capital stack on top of the debt. And they really are the decision makers. When you do a light tech project, once that asset's stabilized, that's a set it and forget it deal. It's a hold, it's a long-term hold. So
yeah, and the good news, I mean, the proof is in the pudding in terms of how you structure the deal, because if there's cash flow, if there's management fees, if the property doesn't need tons and tons of capital to maintain it, the downside with the affordable housing is you're only allowed a certain percentage of increase in the rent each year. So there's no massive run up in terms of the rents versus if it was just you buying an individual property on your own. The
Yep.
difference and the benefit of it, in my opinion, is you have a built-in customer base forever,
Yep.
and you'll never have a vacancy for more than a week, because in a lot of these projects, and that's one of the things I wanted to ask you, especially here in California, other folks that I've spoken to, I mean, they have upwards of a 5 or 10 year wait list. We have tenants in our own apartment buildings who say, well, I'm on a wait list for an affordable housing project. And then I say, how long have you been on it? And they say, well, I've been on it for a year. And I'd say, well, you got 9 more to go, right? I mean,
Yeah.
it really is the golden ticket for the people who get it.
Yeah, no, you're absolutely correct. I mean, just to take that a step further, we're building an 80-unit project right now in the city of Irvine. And I think at last count, we've got 1,000 people on that wait list. And that's
Yeah, and the problem is that, and those people are a combination of people that are either struggling or homeless or just in a regular apartment that want to get, take advantage of that golden ticket because it's a completely different price point. And so there's so many people out there that qualify for it. And then obviously, whoever's doing the lease up and the management on your end needs to try and sift through, even how you narrow it from 1,000 down to 80. That's like trying to go to Harvard, right? Those percentages.
yeah, no, it's very, we have a super robust compliance team. And so that, to your point, they're sifting through those applications. The one misnomer about affordable housing, and there's different tiers. There's, permanent supportive housing, which to your point, those are folks that are quasi-homeless. The bulk of what we do is in that 50 to 120% AMI space. So in layman's terms, in Orange County, just because we're in Orange County, so I'll use Orange County incomes. Really what that means is households making at the low end 42,000 up to, if you're going up to 120% AMI, I mean, you're talking 98,000, and then everywhere in between.
Right. And so somebody else looking at that in other parts of the country would say that's ridiculous. Somebody makes $100,000 a year. A family makes, $80,000, $90,000 a year. How is it that they qualify for these government subsidies and then their rent could be only a couple $100 a month?
No, it's more than a couple hundred. So it depends on the income tier. So if you're a 120% AMI household, you're saving on average maybe 10% of monthly rent relative to market. But to your point, if you're at a 50% AMI rent, then yeah, your savings is considerable. So it really is based on the tier. But what I would say is in Orange County specifically, and we can talk about California and the nation at large, but I'll focus on Orange County. we do have a housing crunch, specifically in, this is an interesting tidbit for you, Barry. Waterford was selected by a group called CLAOC, the CEO Alliance of Orange County, which is a conglomerate of all the largest employers in Orange County. So Disney is part of it, Ingram Micro, PIMCO, Chalk, and Anduril is part of it. One of the things that they have identified as a group, as an organization, is the need for more workforce housing in our county. In specific, and this, Anduril and Palmer Luckey, this has been a huge focus of his. What they've realized is that for them to be competitive as an organization, they need to be able to have housing that's affordable for new first year, second year engineers to really be competitive as they attract talent to move to Orange County. And so they've made it a mission as an organization to look at different mandates and vehicles, if you will, to provide workforce housing in Orange County. They selected Waterford, meaning the CLAOC selected Waterford as a partner to help them do that. And so we've looked at a number of different ways to do that with them in partnership. We're working on something right now with the city of Irvine. We think will be a good pilot for ways to provide workforce housing. And so what that means is, to your point, if you're call it a first year engineer making $75,000 to $80,000, to your point, you can afford to live in Orange County, but one of two things. You may be living in a multifamily unit that candidly isn't up to your living standards, meaning you're living in an older vintage asset, maybe not in the most desirable area of Orange County. And so then really the proposition that you have to look at is, do I want to live in, call it Corona or Riverside County, and have a longer commute time to live in a newer unit that's more accessible to potentially schools or amenities like that? Or am I going to spend more than 35% of my monthly income and be what we call housing burden? HUD defines housing burden as anyone that spends over 35% of their monthly income on housing. And in that instance, if you're living in a Class A unit in Orange County, now you're spending upwards of 50% of your monthly income just to shelter yourself.
And you're stuck living with roommates, and
Exactly.
You're trying to make the best of it. I mean, I think that there's pressure all the way around, right? There's certainly pressure from Sacramento. We've seen it. We've talked to other guests on each city to build more affordable housing, whatever that means in their city. Then there's pressure from employers to try and get affordable housing so they can attract and keep talent. And then there's the city itself, which wants to comply with what Sacramento's doing, and then at the same time be able to afford more housing to attract more people to the city and generate more revenue. And so there's no question of it. The issue then is the implementation of how you get it done, right? And so if you've got the city behind you or in your corner that they want to see it happen, seems like there's less red tape than normally. But it's really a question of navigating through how do I put the deal together. And then I guess I want to shift gears for a second and just talk about the financing side of things, because you do have interest rates still at I don't want to call it an all-time high because that's not true, but in recent years, certainly, close to double what they were before. So money is more expensive. How do you make that work with what's going on with interest rates and financing in today's world? Or is it different because you're getting the tax credits and it's a different analysis?
Yeah, so it's a great question. And, it's all relative. And what I mean by that is, starting from the top, to your point, with the rise in interest rates, it definitely makes things more challenging. So everything is, every deal is tighter, and you're constantly value engineering it and looking for, ways to actually relieve some of the financial stress in terms of making projects feasible. That said, there's also been, a deleveraging in the market where, we've seen, in some locales where, land pricing has come down, so that helps.
You still have
then,
management costs that go up, operational costs,
yeah,
trash,
no, inflation
utilities,
and
everything's just going up.
yeah,
Construction
no,
costs, right?
insurance. I mean, I know you own a number of I mean, insurance costs have gone up.
Insurance is. We could do a couple more shows on insurance if we wanted, but I mean, it's a nightmare, right? I
Yeah.
mean,
No, look, it definitely is challenging, and that's why, our state is in the housing crunch
so
that
the
it
other
is.
thing I was going to ask you, so California, really difficult, really tough to navigate, really lots of governmental restraints. And while it is a great place to live and work and a great place to invest, the barrier to entry is pretty difficult. And the number of opportunities that make any financial sense in today's world, I would just say from my perspective, are limited. I see a lot of deals. Also
Yeah.
see a lot of deals that don't make any sense, where either somebody's selling something at yesterday's number and it doesn't pencil, or they're selling something with ridiculous, returns that's has an inverse cap rate relative to the return. So where do you look? I know you're doing a bunch of stuff in Texas, and are you looking at stuff outside the state of California, and how does that go?
Yeah. So, let me begin by saying we are active in California, but I'll touch on that in a moment. But to your point, as a company, we have expanded into Texas. At the next 60 days, we'll close on our third deal. We'll have over 1,200 units in the Dallas submarket, in partnership with the city of Dallas. We've been doing workforce housing acquisitions in partnership with the city of Dallas, and really and then we're expanding that footprint throughout the state. We're working on an interesting project right now in the city of Austin in partnership with them as well.
And Texas is wow, I was reading an article. It said Texas is the fastest growing state in the country, and the government regulations there to California couldn't be more night and day.
Yeah, it's so from a demographic standpoint, we love Texas. If you look at the Sun Belt, so this is an interesting stat. My business partner told me this yesterday. He just got back from a conference and said that in the developed world, so North America, Western Europe, Asia, some of the highest population growth in what we would say mature economies is actually going to be in the Sun Belt. And specifically, if you look at California population growth, now we have a housing crisis here in Crunch, but population growth is forecasted to be relatively flat the next 10 years, where you're going to see a huge influx of folks into the Sun Belt. But then specifically, you look at employment growth and population growth and the DFW submarket, we're very bullish on that market. And then, to take it to a qualitative level, in addition to looking at demographic growth, job growth, I always like to keep it simple and say, would I live here? I've spent a lot of time in the Dallas submarket, and the quality of life is high. And we think that it's a great community. There's tons of amenities culturally. It's a super diverse city, and so there's a lot going on. So the state of Texas in general, but specifically Dallas. To your point about doing business there, yeah, it's.
I feel like business is more welcome there. I don't want to sound soured on California, but I mean I feel like Texas is a pro business state, pro growth state, and California is sort of a pro let me make up some more rules for you state, and then try and figure out how to navigate it. It's a challenge.
Yeah, we're long California, and we've done a lot in the public-private partnership space in California, and we will continue to. And to my earlier point, we have just over 2,000 units in our development pipeline right now in California. I would say probably 70% of those are affordable/workforce in some capacity, and I define that as meaning that there's income restrictions in place on those properties with a recorded regulatory agreement, and then some sort of, call it public-private partnership financing format, whether it be using tax credits or whether it be using essential housing bonds, which we've done a lot of. And, that's where we've really leaned into growing our California portfolio.
And it's really more new development, right? I mean, it's very difficult. I don't want to put words in your mouth, but you find that it's more difficult to buy an existing product and then try and rehab it and convert it to affordable housing or an existing affordable housing and then upgrade it versus just building from scratch?
Yes. Yeah. It is easier to do that. I will say, we're working with some cities right now on acquisition programs in terms of what that would look like. I would say that that's longer in duration, meaning we're still kind of working through how programs would work. I will say, and you know this better than anybody, I mean, in our large cities in California, you have a lot of older product that is, starting to reach what I would call the end of its functional lifespan. Unless
it doesn't pencil to fix it up, and then nobody will insure it anyway, right? And so you're almost better and forced to look at, what's the highest and best use. I guess the other thing that's exciting about the multifamily market is you see more and more of these projects out there where you're tearing down office buildings that are half empty because the office market's soft and looking at building multifamily.
Yeah. And we're actually doing a large redevelopment in the city of Long Beach, where we bought a 280,000 square feet retail center that had reached its functional kind of life, if you will, and we're repositioning, so eliminating half the retail, so downsizing it to 140,000 square feet of retail, and then we've taken about 7.5 acres of excess land. We're working through entitlements on 900 units on that project, which will be a blend of affordable and market rate housing in the city of Long Beach.
And so,
that's a key kind of function of development, I'd say, in California in general.
And these are big projects. I mean, 900 units here, 400 units there. And do you find that when you hold your hand up and you say, hey, we're going to build this, that all of a sudden there's an influx of people going, hey, I want to be here and get me on the list?
Definitely for the affordable. And then for the market rate, so the Long Beach project specifically, that's interesting because it's a mixed income project, meaning there's 3 phases. We have an affordable component. We have a market rate component. So now kind of shifting into kind of the market rate side of the business in terms of development in California. It's really right now, everything's tricky in terms of just being comfortable with basis, because right now, even though we've seen some costs start to go down, now we're entering into a new phase with tariffs, so we're repricing all of our development pipeline.
Right, and I don't think anybody at this point even knows, what the true impact of it will be. Some people believe, it'll come back down and Trump will back off of it, and others say, hey, I have to deal with the cards I've got on the table today, so therefore I have to increase my pricing. And then, we hear in our shop too, where you have stuff that's made in the U.S. that's not subject to the tariffs, where those people still have pressure from inflation and operational costs, and then say, well, if the stuff that's made overseas is going to be taxed at 100%, I could raise my prices 25, 30%, and nobody would bat an eye because it'd still be a lot cheaper than buying it overseas, and they still prefer to buy from America. And then you'll still see in the short run a run up on price. It'll be interesting to see how it plays out.
Yeah, it's I think we're all starting to kind of, not starting. We're all curious to see kind of what the trickle down effects are, and I think we're probably 90 to 120 days out from really starting to see the first reverberations of kind of what that means on the development side.
And then in the meantime, what do you do from a business perspective? You got to continue to move on, but you've also got to make sure that you're making sound business decisions and not overextending and not making a deal just to make a deal that doesn't really pencil at the end of the day.
Yeah, no, and that's so on the development side. I'll tell you what our strategy is to be successful on the development side, it's all about land basis, and we feel really good about our land basis on that Long Beach opportunity. That was a distressed deal that we bought from a bank during COVID because the previous retail operator had essentially fallen into default. So we bought that knowing that it could be a long horizon, if you will, until we were ready to go vertical on it. We're now, believing we'll be going vertical next year. We're working through the entitlements, and then we'll be working through the construction drawings. We feel really good about that project specifically because we've got such a great land basis. But to your point, in terms of other development projects, it really comes down to what your structure is on your land. I mean, I will tell you, I don't want to necessarily call people out, but there's certain projects in Southern California, specifically Orange County, that the last few years they've way overpaid for land, and they're completely upside down. Those are multifamily development market rate projects, and I don't see those projects going vertical anytime soon. And so
it'll be interesting to see. I mean, I think it's a challenging time, and you got a lot of people on the sidelines looking for deals, waiting, trying to figure it out, and it's tough to pull the trigger.
Yeah, no, I agree. It's an interesting time right now.
So Paul's waving at me that we are out of town. We could talk all day about this stuff for sure. But if people want to find out more information about the company, what's the website that they can go to?
Yeah, it's www.waterfordco.com. I'll just leave with this, that, our expertise and really, our mission as a company is, we specialize in public-private partnerships, and really we'd like to, really pitch ourselves as being resources to cities to help them figure out how to provide housing at all income levels, whether it be at the deepest tiers of affordability to the middle tiers of workforce, or in market rate housing. And so that's where we set ourselves apart, is instead of saying we're just affordable developers or we're just market rate developers, we're really innovative in the way that we look at capital stacks and financing, and really want to be resources for public partners.
And the good news is, look, the demand and the desire out there, I don't think could be at more of an all-time high, with all of the pressure from Sacramento and the just natural housing crunch. I think all of these cities are looking for ways to be able to get projects on board, and they need guys like you out there to help them facilitate it. So I would just say, look, it sounds like the sky's the limit in terms of getting out there and just making the right kind of deals, and you've certainly been extremely successful, and so I'm glad that I could have put a roof over your head early on to get you going. And if you ever need a place down by the beach, you just let me know. I got a place for you. But I do wish you I do wish you continued success for you and your family and your company, and happy to have you back on the show. We'll talk about, maybe we'll have you come back in 90 days. We'll see where we're at with the tariffs and see how it affects what you're doing.
I would love that.
But I do appreciate it. And for everybody else out there tuning in, hopefully you picked up something today. And if you didn't, try again next week. We'll try and make something up that's even more interesting and exciting than affordable housing, although Sean and I both like it. But for all of that, I am Barry Saywitz, president of the Saywitz Company. And if it's one thing I've learned in my 30-plus years of doing this, it's to try and surround yourself with good people, make good decisions, and hopefully we've helped you do that a little bit today. And so we'll see you back here next week on Let's Talk Real Estate.
Well, there you have it. You've been listening to Let's Talk Real Estate, your weekly BS with Barry Saywitz about the current state of the real commercial real estate market right here in Southern California. On Orange County's only community radio station, OC Talk Radio, streaming live from our studio here at the University of California, Irvine's